5 ASX stocks to hold through 2022 and beyond. So as the video title explains, that's what we're going to be looking at today. Now of my list, 2 of the companies I'm going to mention I do currently hold shares in, and 3 of them I do not. I do plan on getting the other 3 at some stage if I see a buying opportunity, if the price backs off a bit. Now just one more important note before I start with the stocks. These are companies, all 5, that I personally like the outlook of and that I think will do well in the future and next year. So if you also like any of these companies, please do your own research into it too, so you're comfortable putting your money into it if you feel to do so. Please don't throw in your life savings into a stock just because I think that they're going to do well. So the first stock that I'm going to cover on this list that I think is positioned to perform really well through 2022 and beyond is Macquarie Group Limited, or ASX code MQG. So Macquarie is a global financial services company and an independent investment bank, and they're pretty much an alternative to the main big 4 banks that are very prominent through Australia, being the Commonwealth Bank, Westpac, NAB and ANZ. Of the 4 big banks, I think Macquarie is positioned for the best growth over the future. And I've been meaning to buy Macquarie shares for 3 years now, but they just seem to continue to skyrocket. They did dip through COVID. They dropped down to about $80 per share from $150, which was their high before COVID. And since then, they've rocketed back up to $200 now, which is their all-time high. Macquarie was founded in 1969, and as of the recording of this video, they currently manage $737 billion in assets. So they have a fantastic record of investments, and they're a very stable ASX blue chip bank. I definitely see them as a very defensive stock. You're never going to lose all your money on Macquarie. They're going to be around for a long time. But despite being defensive, I do think that they are still positioned to have a lot of growth in the coming years. They've got a very good investment record, as I'd mentioned before, and I can definitely see them pushing up into the $300 mark maybe in the next few years. They have a dividend yield of just above 3%, which is slightly lower than the approximate 5% dividend yield average of the other 4 big banks on the ASX. But for me personally, I'm not overly interested in dividends. I'm more interested in the capital growth of my investments. And compared to the other 4 big banks, the data of how they've performed over the past 1 year and 5 years is here. And obviously past performance is not always an indication of future performance, but we can see that they're 10% better from their 1 year increase than all the other banks, and over the past 5 years performance, they are more than triple the best of the next best bank, which is Commonwealth. So an investment of 10 grand into all 5 of these companies over a 5-year span would look like this today. And you can see from that why I value the capital growth more than a small dividend yield. Although dividends are a preference to the investor, some people like to live on their dividends, and if you're interested in large dividends, then maybe you'd want to consider one of the other big banks. Macquarie does offer a dividend reinvestment plan, which I like very much. Any company that offers a dividend reinvestment plan that I'm invested in, I will always sign up for it. And basically a dividend reinvestment plan means that rather than paying out your dividends to you, the company will acquire more of their own shares at the price of when they pay out the dividend in your name, and you're not going to have to pay brokerage on that acquisition of the new shares. So yeah, that sums up Macquarie, and I really do like their investment strategy, and I believe that they will outperform the market, being a very safe defensive blue chip stock while also having a lot of potential for high growth as well. The second company I'm covering on my list for companies to buy through 2022 and beyond is ResMed, or ASX code RMD. ResMed are a global healthcare company and specialize in sleep technology for conditions such as sleep apnea and respiratory conditions. So ResMed's currently around $35, and they've recently, over the past couple months, fallen from their all-time high of $40, which I think could potentially be a sign of a good buying opportunity. It's definitely tempting for me. I don't have ResMed stock, but I would like to get some. What draws me to ResMed is the satisfaction I have heard about their products and sleeping technology. I do know people who own ResMed sleeping machines for sleep apnea, and I have heard that they're very, very effective and have been much more successful than what was expected and what they were expected to be. And I firmly believe that a reliable and effective product is always going to stand tall above all of its competition. I think where ResMed is positioned to perform really well into 2022 and beyond is because two things: the aging population and also the increase in sleep condition diagnosis with modern doctors. And this increase in awareness, as it wasn't really a thing that people knew about or diagnosed a lot in the past, I think this positions ResMed very well to have a huge consumer base and increase in demand for their products in through the future. ResMed offer a dividend yield of 0.6%, which is quite low and lower than the 1.7% yield for its sector average. As I covered with Macquarie, this doesn't particularly faze me as I'm not a dividend investor. It may faze you if you are a dividend investor, but I'm personally more interested in the capital growth of the investment, and I think that there's huge potential through the aging population and the increase in sleeping condition diagnosis that this could really take off a lot over the next year and beyond. ResMed is up this much over the past year and over the past 5 years. ResMed do not offer a dividend reinvestment plan, which may be the only thing that bothers me just a little bit. For me, I would like to always have a dividend reinvestment plan on my companies just so that they can continue to reinvest in themselves and increase the capital growth without me having to go out and reinvest the dividends myself, because that would be at the cost of extra brokerage. But if you're not interested in dividend reinvestment and you're more interested in the dividend, you can pocket the dividends, or you can reinvest them elsewhere, or you can reinvest them back into ResMed yourself. The third company I think is positioned well for the future is Washington H. Soul Pattinson, or ASX code SOL. Soul Patts is an investment house with a very broad portfolio. They own large stakes in a lot of Australian industries. Their biggest three holdings are in Brickworks, TPG Telecom, and New Hope Coal. Soul Patts pretty much has its hands in a lot of pies. It has a lot of companies that it invests in, and it's been a very successful investment house over the past 100 years that it's been listed on the ASX. And it has currently the longest streak of dividend growth on the ASX, which has lasted for 20 years, which is very enticing to me, as they were able to maintain this through COVID, when a lot of companies did actually have to cut their dividends. Soul Patts has recently dropped to near $30 after climbing to an all-time high of $40 just a couple months ago. For me, I kind of see this as a opportunity to potentially buy more shares in it. I've heard Soul Patts referred to as the Australian Berkshire Hathaway in the past, which, if you're unfamiliar with Berkshire Hathaway, is Warren Buffett's company, who is probably the most successful investor in history in America. And while there is no actual physical link between these two companies, they do have a similar investment strategy, and the CEO of Soul Patts, Robert Milner, is in his own right very successful and a highly renowned businessman in Australia, and I think he's also a billionaire off of his own work. And I'm quite confident that Soul Patts will make good investment decisions and continue to drive the firm's stock back up to its all-time high and beyond. The fourth stock, which I think will perform well through 2022 and beyond, is called the Betashares Nasdaq 100 ETF, or ASX code NDQ. The Nasdaq 100 is an ETF that has holdings in the top 100 stocks on the Nasdaq Stock Exchange in the US. A lot of the modern day tech giants have been listed on the Nasdaq exchange, which is the reason that lately the Nasdaq has soared as these tech giants just continue to make billions and billions of dollars. I have recently bought shares in this ETF. Betashares is the fund manager, and they manage billions of dollars of investments across the world and in all different kind of markets. This particular ETF, once again, it tracks the index of the top 100 listed Nasdaq companies. So if a couple companies underperform that are in the top 100, they may fall out and you'll get 2 new companies come up, which is good for this stock. And once again, having a portfolio manager really helps, and it makes you feel quite more comfortable investing a decent chunk of money in it. 45% of the holdings in the ETF, so almost half, are across the main 5 FANG companies: Microsoft, Apple, Amazon, Google, and Facebook. The other 55% of the portfolio is spread across Tesla, Netflix, PayPal, Nvidia, eBay, and 90 other huge companies in America. I believe this ETF is placed to perform very well, as it holds some of the biggest monopolies in the world, and these companies have such a tight hold over their market, and they really edge out all of the competition for a lot of their products. So 2 huge pros that immediately stick out to me about this ETF is that it gives you exposure to companies in America from Australia without having to do 2 painful things, being filling out American tax forms and converting your currency across to USD and then back to AUD. So filling out American tax forms is a real pain in the bum. And filling out tax forms from any other country is very painful, and you would only really want to mess around with that if you knew what you were doing and you could see significant growth over there. And converting your currency, you always lose chunks of money converting across from AUD to anything. But considering you have to convert your money to invest in American dollars, and then when you take your profits, you'd have to convert it back to Australian, it just takes out chunks of your money that just increases the risk of losing money from this investment strategy. And this ETF pretty much is a very simple, straightforward, and safe investment for someone who doesn't know and want to deal with all these kind of variables. They just want to invest in the big tech companies in America. Another notable risk, or I guess the only thing that you need to consider with this, is it's not currency hedged, which means while you don't have to convert your money to American and back to Australian to invest, if the Australian dollar improves against the American dollar, then it reduces your return of this investment, because it basically means that the investments of Betashares are worth less in Australian dollars, which is our currency, if the American dollar gets weaker against the Australian dollar. So that's one factor. But if you want to limit that factor as well, there is a currency hedged alternative to this fund, which is called the Betashares HNDQ, or ASX code HNDQ. And this basically means that any changes of the American and Australian dollars does not impact the ETF price. It's purely focused on the performance of the top 100 Nasdaq companies. So getting the hedged version of this fund it offers a slightly higher management fee just to cover the Betashares risk in currency movements. Betashares NDQ offers a dividend yield of 3.4%, which is quite generous, and they also offer a dividend reinvestment plan, which means you can reinvest this dividend back into acquiring more stock without having to pay for brokerage, which obviously, as I've said twice already, I really like. The Nasdaq ETF has a 0.48% management fee, and the hedged Nasdaq ETF has a 0.51% management fee. So this translates to $48 per year or $51 per year if you invest 10 grand. And for if you're investing only 1 grand in this, it will only cost you about a $5 management fee, with a difference of maybe 30 cents between the hedged and non-hedged ETF equivalents. If you are concerned about management fees, and I guess any fees are not ideal, a couple things to consider is that the dividends of this investment do cover the management fee 6 times over, but you also do have the security of an expert managing your money by having a management fee. But nonetheless, they do eat into your profits if they are too high. But personally, I believe the Nasdaq will continue to increase as it has in the past decade. Over the past year, the American Nasdaq Stock Exchange has risen this much, and it's risen this much over the past 5 years. So this is the actual American market. This is not the ETF equivalent, because this ETF has not been around for 5 years yet. And this increase over the past 5 years is significant for an index, as it pretty much means the average increase of all the companies that it holds, all the 100 companies, is up by that amount, and not just the best performing companies such as the FANGs or Facebook, Apple, Amazon, Netflix, Google. The second ETF for this video, and the fifth and final stock that I'm going to give that I believe will perform well in 2022 and beyond, is the VanEck Video Gaming and Esports ETF, or ASX code ESPO. ESPO is an ETF that holds 26 of the biggest gaming and esports companies across the globe. So this is not specific to America. There's holdings in Japan, China, all across the world. The video game industry has been on a rampage the past 10 years and is projected to pass $65 billion in 2021 in the US. I actually know someone who did their university thesis on video gaming and addiction, and he found that the video gaming industry in the US is now bigger than the movie and music industries combined. And it also bears similar viewership to that of the NBA and the NFL. The gaming industry is poised to be the highest grossing industry in the world, and I personally don't think there's anything that can stop it other than the apocalypse. I think that this has the potential to skyrocket as adults begin to develop more of an interest in gaming, and as kids age and turn into adults, and before you know it, a significant portion of the world will be playing video games. I would be interested in buying individual gaming companies also. However, I haven't done as much research into them, and I would need to expand my research if I was to do that. But for now, this ETF seems to be the safest bet to get exposure to the gaming sector. Now, admittedly, this is the riskiest stock of my video, and probably has the highest potential upside to me also, which is why it made the cut. It has been listed on the ASX for 3 years now and is up that much in that time. VanEck is the fund manager, and they manage billions of dollars of investments across the world, across different markets. It's very similar to Betashares. This particular ETF tracks an index of 26 companies it holds in esports and in the gaming industry, as covered before. The largest holdings in this stock are in Nvidia, Nintendo, Roblox, Activision, and Ubisoft, which you may recognize as the developers of Pokemon, Call of Duty, Assassin's Creed, and many others. And there's several companies in this ETF which you would have never heard of that are gaining traction in the esports and competitive gaming industry. I can see these companies increasing dramatically as the esports community and competitive gaming increases and slowly takes over to be the highest grossing industry in America. And a huge pro of this ETF is that it gives you exposure to the biggest gaming companies across America, Japan, the UK, and China, which would typically be a nightmare for the average person to manage investments and paperwork across so many different international stock exchanges with so many different international tax laws. But this gives you a very simplified equivalent to being able to invest across all these industries with your Australian dollars and with just a small management fee. So the ESPO ETF offers a dividend yield of 0.13%, which is very low. But this isn't always a bad thing, as it means less money is being taken out of the ETF's value. An investment of 10 grand would reward you $13 in dividends per year, and an investment of 1 grand would reward you with $1.30 per year. But it's important to remember that this is more about capital growth, and as this ETF ages to be older than just 3 years, I'm sure the dividend will also increase as it encounters more success. The management fee for this ETF is 0.55%, which is just on the more slightly expensive side and is higher than the dividend it pays. This equates to $55 per year from 10 grand investment and $5.5 per year from a 1 grand investment. But once again, I'm more interested in the capital growth, which has been this over the past year, and this since its inception in September 2020. Now, once again, remember, if you are interested in any of these companies, please do your own research and make sure that you are comfortable with investing in them, because I am not a financial advisor and I don't know your situation. I just do my own research, as I have done for the past few years, and I pick out stocks which I believe are poised to do well for my own portfolio. But I do hope it put a couple things on your radar and was worth the time. Thanks for watching.